Hello everyone, this is Shinichiro Kasai, licensed real estate agent in Japan. Today, I'm going to share an eye-opening data on the permanent shift happening right now in Japan's office market. We are seeing a complete transformation driven by supply exhaustion and soaring relocation costs, leading us into a new era of landlord supremacy. So let's dive into the data. First, let's look at Tokyo. The market is experiencing overwhelming excess demand. In fiscal 2025, the contracted area in central Tokyo was double the amount of newly recruited space. As a result, the total vacancy rate across Tokyo's 23 wards has plummeted to just 1.38%. If we look at prime areas like Chiyoda Ward, it's essentially at zero, sitting at an incredibly low 0.65%. Vacant rooms have practically stopped circulating. The Tokyo X-Cross. This chart, which we call the Tokyo X-Cross, illustrates this structural shift perfectly. Over the past years, from May 2025 to May 2026, we see a sharp plunge in vacancy from 3.68% down to 2.07%. Conversely, the average rent has surged for 28 consecutive months, reaching 22,845 yen per tsubo. The intersection of these two lines marks the definitive transition to a landlord's market. High-end inventory exhaustion. When we zoom in on specific premium districts like Yaesu, Kyobashi, and Nihonbashi, the situation is even more extreme. Middle price inventory is completely gone. Landlords are now only recruiting for high unit price spaces. This dynamic has driven the average recruited rent in these areas to staggering 74,000 yen per tsubo. If you want prime space, you are paying a heavy premium. The macro engine. What is driving this unyielding demand? The macroeconomic engine remains highly resilient. Despite global energy tensions, Japan's real GDP is projected to grow by 0.5% in fiscal year 2026 and accelerate to 1.1% in fiscal 2027 fiscal year. Combined with declining unemployment and rising overall employment, corporate appetite for expansion remains fundamentally strong. The regional spillover. And this is no longer just a Tokyo story. We are witnessing a massive regional spillover. Supply-demand tightness is actively spreading to local core cities. In Nagoya, rents have increased for 16 consecutive months. In Fukuoka, it's been 27 consecutive months, and in Osaka, large new buildings are being unofficially filled by tenants before they even finish construction. Osaka's breaking point. Let's look closer at Osaka's breaking point. Over the past years, vacancy has dropped from 3.83% to 3.04%, marking a 5-month consecutive decline, with the 1% range now in sight. At the same time, rents have climbed for 8 consecutive months, hitting 13,000 13,239 yen per tsubo. Osaka is now hitting post-2000 record highs for rent. The shortage is severe. The relocation hurdle. Normally, when rents go up, tenants look to move, but moving is no longer a viable escape valve. Tenants are facing a massive relocation hurdle. Material prices remain high, and severe labor shortages have caused pre-occupancy construction costs and original state restoration expenses to skyrocket. Relocating has become prohibitively expensive. Market polarization. This creates severe market polarization. Landlords who can offer added value to offset these relocation hurdles are thriving and can easily ride the rent hike wave. However, stagnant properties, those offering standard bare spaces without added value, will struggle to justify higher rent to cost-conscious tenants. Divergent landlord strategies. This polarization has led to divergent landlord strategies. On one side, we have the set-up office model seen in areas like Toyosu and Harumi. Here, landlords pre-apply the interior. This suppresses the initial relocation cost for the tenant, allowing the landlords to capture a higher monthly rent. On the other side, landlords use free rental extensions for standard spaces. This maintains a high surface-level recruited rent while offering a hard-to-see substantial discount behind closed doors to close the deal. The Captive Tenant Equation. This brings us to the Captive Tenant Equation. Landlords can confidently command higher rents because for many tenants, the math is brutally simple. The cost of relocation is vastly more expensive than simply accepting the rent hike. Rent hikes are practically protected by these high relocation costs, leading to a structural fixation of landlord superiority. The new era of added value. In conclusion, we have entered a new era of added value. In this high-cost, low-vacancy environment, real estate competitiveness is no longer just about location or base rent. It is new entirely defined by a property's ability to absorb or mitigate tenant relocation hurdles. The landlords who solve this cost equation for their tenants are the ones who will emerge as the absolute winners. Thank you for watching, and please subscribe and press good button. Thank you very much, and see you soon. Bye.